Welcome back to the channel. My name is Brad, and today we're just going to look at all the cover calls, at least the ones that I'm even close to being interested in, show you what I think. I'm going to also go through some hedging maybe, and we'll talk about that. But first of all, we're going to go ahead and say none of this is financial advice or any other advice. It is just Brad out on the internet showing you some graphs, charts, and data so you can make your own independent decision. But at the end of the day, we are going to go ahead and say, let's dig into this. First of all, second of all, I already said first of all. Second of all, hey, if you haven't checked out the new membership and where we are at on Circle, we're doing pretty good. It is actually fun. I'm there every single day, posting something or talking about something or doing group chats, showing data and answering some questions about what charts and where. So get a chance, go check it out. But today you didn't come hear me say any of this stuff. I came to go ahead and show you the charts and look at the top ETFs that are out there. And we're really going to focus on three different subject matters: S&P 500, NASDAQ, and can you hedge? That is the question, because everybody's worried about a big downturn, and I'm going to just show a little bit of data so you can actually rest a little bit easier at night. All you got to do is subscribe to the channel or join the membership club so you can actually follow along as we go. And Quan, I will be there at 12 o'clock today on X, on Quan channel, and we're going to be doing some spaces with Quan today, talking about a little bit of Bitcoin. But if you want to go check that out. So let's go ahead and dig into this, right? But here we go. Somebody keeps on saying, I don't want to hedge at all-time highs, but we'll just talk about that here in a second. We're going to go bring up the graph. And I brought this up, max data for the funds that were available. And I picked as many funds as I've chosen before in the past. And I'm going to go ahead and show you SPY being the highest. Then we have GPIX, which I actually do own, but I do not own Bally. Bally came in second. And then you can see where the rest of them come in, being QQQI, and then they tear down from there. But the ones that clearly fall to the bottom are XYLD, and you can put JEPI in there, and Devo does pretty well. But there you go. You can see for yourself, and some of these things have been around for a very long time. These are not new funds. I just went out and picked out what I could find out on the internet. I've done that before with these exact same funds, but here they are for you to go check them out and make your own decision. I tend to go to the ones that have decent price change and total returns. Nothing wrong with something that has something going down, but I like something that tries to keep its price. And I look at this one and I see that, again, GPIX stays at the top, followed by Bally. And we don't talk about Bally. And I know Bally is not an S&P 500, but it's not a QQQ either. So it's not on the NASDAQ. I just threw it in here just to make sure it's well-rounded between all the funds. But I also look at distribution rates. And one, PUTD, I don't think that was correct, but at least the source that I have, I literally downloaded it right off stock analysis and came up with these numbers. But you can see where you are, and you get to choose your distribution rate, because a little bit higher distribution rate may lead to less price increase. It's all about what you want and what your needs are for your individual self, not what I need. But if I look at these charts real quick again, I see Bally and GPIX. And I look at that and go, wow, we can really see that Bally and GPIX have very similar distribution rates. That just goes to show higher distribution rates may lead to a little more or less price increase. I'm not even going to call it NAV erosion because when you look at the chart, it's all positive on price change. So none of these really had what I'm going to consider NAV erosion over a multiple year. Now we can all say, hey, it has been a bull market, but we did have some downturns. And you can see which ones recovered in price after the downturns. Now, I like to have multiple rods out there fishing, right? Because I did not talk about zero DTEs because I put them in a separate basket just because they haven't been out as long. And when we look at that, we look at the zero DTEs and we look at total returns. And I also threw in GPIX because GPIX was leading the way on the last slide. So you can do a comparison. So I see on this, the T-SPY continues to lead the way. There you have it. And I'm going to give Cy a big shout out today. He wrote 0 calls today. And somebody goes, oh, well, you know what? He didn't get capped. He saw all the gains because he said, the risk is a little high with Powell speaking. So he didn't write calls and he captured all the gains today. Maybe he'll write one this afternoon. I don't know. That's not my job to judge. My job is to judge that chart and say, that's not that bad. But when I look at price change, well, I can see that T-SPY at least is above board. And there you have your XDTE down below. But if I go back to the last chart, XDTE didn't do that bad on total returns, but it didn't beat others. So I'm just going to go like this going, hey, if you're not beating total returns, why are you going to settle for the price going down? And that's just me. You can do you because maybe you need that extra income. That is for you to decide. Now we're going to move on to the NASDAQ. We're going to just go ahead and look at what the NASDAQ is doing. And these funds are a little bit newer. So I try to take as much data as I could to give you a complete look at the market, at least from my perspective. And lo and behold, wait a second, who are these guys? We have TDVI and QDevo sitting out there. And that is something that's for people to actually take a look at. And KQQQ. When you look at total returns, you have several new players out there that maybe you've never even heard of. QDevo, KQQQ, and of course, then you have QQQI and the rest of them. I did throw in the zero DTE in there, but hey, there you go. And somebody said BUTD was a year-end special. Oh, there you go. That's probably why it was high. I didn't go look. It just seemed high. They normally were much lower, closer to that normal 9-10% range in the past, at least from what I was seeing. But when I look at the NASDAQ, well, that just tells me right there that you should be looking, or at least I think you should be looking, not advice or anything, at the top players, which is QDevo, KQQQ. I own QQQI and GPIQ, but I also started QDevo and KQQ just because they seem to be pretty good funds. Now, if I look at price change, and there you have that same conversation, just because you had higher distribution rates, maybe you need that extra income. But that is all what you really need to think about. So taking a look at this, you can see where each fund is and make your own decision. I like the ones, personal opinion, that seem to have high total returns and high percentage of price change. That's just me. You get to do you, and I get to do me. But at the end of the day, that's how I look at the market. Remember, I am taking 8% of my cost and trying to live on it. Some of these may not pay that 8%, but they're pretty close, 7.5. Hey, I think I can live with that because I want to see both, especially in a up market. And here's your distribution rates. And there's your QDTE leading the way, a little bit high, but at the end of the day, they had the biggest price decline. But you might need the extra cash. That is up to you. But then again, TDVI, and you can see QDEVO and KQQQ are a little bit less. Then what I'm going to say, the standard is right around that 10%, being JPIQ and QQQI being at 14. But there you have it. You can go look at the charts yourself. These are all on stock analysis. This is where exactly I took the data from. I did do a couple more charts bringing in the data. So the first charts were the max data that was available for all the funds. But then I started eliminating some funds to give us a little more data. And you can see that TDVI has done very well. And I don't talk about that fund very often, but I did do a video, I don't know, 6-7 months about it. There you have it. Take a look at that. We can also go out to March of last year. Again, TDVI. And if you see that, TDVI is actually beating QQQQ. You don't usually get that on an income fund. Pointing out what the data is saying. And if I go to a even shorter time period, or January, you can see again that TDVI is actually beating the Qs, but it has a smaller distribution rate. Just want to make sure that you are aware of that, and make sure that you go check out these funds because each one has its own purpose. And again, I use multiple fishing rods. I like 2 or 3 different funds on the Qs because who is going to win today? And that is always the question. I actually did look at QYLD, QYLG, and QYLE, and I'm just going to throw my hands up and say, no, I think you're better off with QQQI or one of the other funds that I've already shown. I think that these just haven't really performed as well as probably they should, but that's just me. But I'm only pointing out what the graph says. So now I'm going to point into the hedge. Can you hedge? I don't know. Maybe you can. And this is where I kind of disagree with Jay's book. I look at this and say, one, if you had a little bit of gold during the downturn, March through July, well, that GLDI actually did very well on a price. This is just price change. There you have it. When we look at price change, GLDI actually did what it was supposed to do with being on gold and hedge the downturn. Now, that's totally up to you. I actually saw this on Seeking Alpha. Somebody had a graph like this, and I said, man, that's actually very interesting. So having diversified assets can help you hedge just so slightly to actually make sure that you're not losing capital. I also looked at total returns, and total returns told me the same exact thing. GLDI actually helped out during the downturns. If I look at SPY and GPIX, exact same thing. Price change. I saw GLDI held its price. Now, I'm going to talk about hedging. And there's 2 different ways you can do this. I am not going to tell you which way is the best way of doing it, but I'm going to give you 2 scenarios. One scenario, I'm going to say you could just buy a put. You really could. You could buy a put, but buying that put does not pay you income. Keep that in mind. Now, if you're in a taxable account, buying a put is probably a better option. Just throwing it out. If you're in a IRA, well, an IRA, you can actually swap things out without tax consequences. Just keep that in mind. So I took the 200-day simple moving average and I said, okay, here's the 2 dates that it went across the 200-day simple moving average. And if you've been following me, I told you then that I actually sold my growth side and I wrote it all the way down and then bought back in when it came back up. So I didn't have my growth just tearing my account down. And that was a psychological thing for me. And most of the time, this is a psychological issue. But if you would have gone into YQQQ at the exact same time periods, and this is total returns, well, lo and behold, you can actually buy a yield max fund that actually will hedge this type of scenario. Maybe you put 10, 15, 20%. I don't know. That's totally up to you. But you can see what had happened during that exact same time period. What happened is total returns, they went up while everything else went down. That is what you're looking for. So there you have it. I also looked at price change and said, what happened to the price of YQQQ? Because let's say you're going to say yield max, they always just go down in price. Well, lo and behold, price change, it went up. So it did do exactly what they said it was going to do. So congratulations. You could have hedged if it went below the 200-day. And that's what I'm just going to use. If it goes below the 200-day, maybe I just buy a put. Maybe I put a little funds into YQQQ to actually hedge that downside until it comes back up. But looking at what Powell's doing to the market, I don't think that we have that issue anytime soon because he has pumped the market very well today. So there you have it. Buying a little bit of gold, maybe buying some Bitcoin. Bitcoin actually went down. I looked at that. But buying some gold or something like that can help you hedge those downturns. So hopefully you enjoyed this content and make sure that you get on X here at 12 o'clock and join Quan and myself. And we're going to be talking about some Bitcoin ETFs for income. So until next time, God bless.